this is R. Any question until now? Very easy, right? By the way, if you are trouble with R, there is resource. You can simply click resource. Then there are a bunch of YouTube lectures about R. On introduction to R, intro to R, blah blah blah. You can go to YouTube and take lecture. Okay, no problem. Right? Easy. Okay. Anyway, this is R. So in R, we use arrow. Use arrow. So let's say A. I want to assign 100 to A. Then A. Arrow to A and 100. Then A has a value of 100. Let's say B has a value of minus 150. Okay? Then what is A plus B? 50? 마이너스 50이지. 마이너스 50. Okay? A multiplied by B. What is it? A multiplied by B. This seems the correct answer. B minus A minus 1.5. Any question? No question, I guess. Now, in order to do the homework, my homework, you wanna install Black-Scholes formula with R. Implement Black-Scholes formula R. I didn't teach you what is Black-Scholes formula, which means you don't have to know what is Black-Scholes formula at all to do the homework. This is enough, okay? So you don't have to know anything about Black-Scholes formula. Anyway, in this homework, this is input variable. C or P is output variable. Okay? So let's write down small program. In order to write R program, one easy way is go file, new script. Script is a program. In script, you do the homework. New script. And let's save file as a D drive. Okay. I'll go D drive and temp folder. And then I'll save this one as a black.r. Okay. Black.r is my program name, script name. Okay. So this is all input variable. So let me copy and paste this. Okay. So here, 핸드폰을 꺼버려야겠네. 이럴 때만 메시지가 날라오면. 자, let me say S0 is the current spot rate, or current is called current stock price. So let's say S0, I assign S0 as a, let's say 100. Let's say S0 is 90, for example. And if we put shop over here, then anything behind the shop, 물정자, computer cannot read anything next shop. Okay. So S0 is the current spot rate, right? So it is very convenient, right? I assign 90 to S0, and then I put this memo over here. So this memo is for myself. So computer cannot read it. So for myself, I keep note over there. Okay? And then in homework, K is the stock price. Let's say K is the strike price. Let's say it is 100. So I put K. K is the strike price. Third, N is cumulative normal distribution function. Let me skip this. And then domestic interest rate, RD, is domestic risk-free rate. Let's say RD. The risk-free rate is currently about Bank of Korea like 3%, so 0.03. are these domestic risk-free simple interest rate. And then next RF is the foreign risk simple rate. Let's say it is 1%, 2% say. Okay. RF is foreign risk simple interest rate. And then T, okay. No, RF, okay. T is the time to maturity. So T is time to maturity. Let's say T is 1.5 year, because everything is annual, right? So 1.5 years. So T is the time to maturity, calculated according to the, so let me keep this. Tap. Okay. And then sigma, okay? This is unfortunately not alphabet, so I have to write down as a sigma. Okay, sigma is, let's say, 0.4, about 40%. Okay, so I just wrote down my input variable. So given this, basically we can calculate collector's price. So I don't want to do homework at this point. So in your homework there is CP. I will write down only this part. Okay, only this part. So you will add this part and this part. So it says C equal S0 EXP minus RFT NT1 blah blah blah. Okay. Here I know, okay, S0 RFT I define everything, but N is called cumulative normal distribution function. Okay. Then what it is? What is the cumulative normal distribution function? Copy, go to Google. Cumulative normal distribution function, okay? Cumulative distribution function is blah blah something like that, and then normal distribution is the easier one. Normal distribution looks like this. This is normal distribution called the density function, right? This is called the probability density function of normal distribution. Probability density function for standard normal distribution looks like this. Okay? And then cumulative distribution is just integration of this one. Cumulative distribution function is, where is it? This one, okay? Cumulative normal is basically this one. Integration from minus infinity plus x e, and this part is density function. So yeah, basically minus infinity is the area of cumulative distribution below minus infinity, so it is 0. Area below 0, this one, pi 0 is, this function is exactly half symmetric with 0, so it is 0.5. Density function, infinity, everything is less than infinity, so it is 100. And because of symmetry, nx equals 1 minus n minus x. So this is basically n. Good news is that in R, you don't have to do this integration with programming. There is already function in R, which is called P norm. Okay, so P norm is R. Okay. So in our homework, instead of n, you can write that to the P norm. So we can do homework, right? So for the part of homework, C is, okay, let's go one by one. Okay, C is S0. You can just write down this equation. S0 multiplied by EXP minus RF multiplied by T, and then instead of N, you write down P norm, and then D1. Okay, basically it's done. Okay, of course you have to add the other part, but there is one small problem. here if I use D1, but D1 is not defined beforehand. So I have to define D1. So I have to define D1 first. So D1 equal to, okay. And then what is the D1 over here? There is answer. D1 looks like this. So D1 is log, ln is log, okay. Log S0 divided by K plus RD minus RF, and then sigma 제곱 divided by 2 multiplied by 2 and divide this entire thing, okay, with sigma t 0.5. So our homework is basically done. So next we have to run this program. Okay, how to run this program? First, in order to run this program, we have to know where this file is. Right? This file is D drive temp folder. Right? So I have to set working directory. Set working directory, and then I have D drive. And then instead of this one, we have to use slash in R. Slash temp. Okay? So this is our working directory. Inside the working directory, I have a file called black.r. So I can simply run black.r. In order to run the program, it is source black.r. So I run, this is done. So in order to see what is the value of call option C, okay, so I simply type C. Value of call option is about $45. Okay, let me change the ball value. So I lower this one like a 50. Okay, then the value of C should change, right? Should change. Therefore, I have to run this program again. Type C. We have new value, which is 6. Very easy, right? You can write down this one or take a picture of this page if you want. I'll give you time. So you can do the homework, right? You can simply print out this page and submit it next class.
The topic for today is mechanics of futures markets, and I'm going to talk about this a little deeply. Okay, futures contracts are exchange-traded obligations to buy or to sell a certain amount of underlying assets at a specified price and date. And these underlying assets vary from agricultural products such as corn, wheat, and to stock indices or gold. In futures market, there is always the same amount of long and short positions, which means that it is a zero-sum game in which if a long position gains money, then the corresponding short position loses money. And when a new futures contract is introduced in the market, the following terms must be defined. Types of underlying assets, what can be delivered, and delivered location, where it can be delivered, and the delivery time, when it can be delivered. And before we get into details, I think some terminology should be introduced first. So, okay, open interest, the total number of contracts outstanding. The open interest equals to the total number of long positions or number of short positions. Settlement price, the price just before the final bell each day, and volume of trades in one day. Okay, futures contracts are settled daily, and most contracts are not held to take the delivery of the underlying good. Instead, they are closed out or reversed prior to the settlement date. This is the table that shows crude oil futures contracts tradings on prices on May 14, 2013. As you can see, the first column shows the maturity date, and rest are the prices, and the last column shows the volume of trading. Okay, let's get back to the slides that we've just skipped. Arbitrage forces futures price and spot prices to be the same at the maturity date, and the difference between futures price and spot prices is called the basis, and the basis converges to 0 as the maturity comes. And a margin, cash, or highly liquid collateral placed in an account to ensure that any trading losses will be met. The amount required to open a futures position is called the initial margin, and the maintenance margin is the minimum margin account balance required to retain the futures position. So if your balance falls below the maintenance margin, you should fill it up to the initial margin. The amount necessary to do this is called the variation margin. And here's the example. An investor takes a long position in 2 December gold futures contracts on June 5th. The contract size is 100 ounce. Futures price is $14.50 and the total initial margin requirement for the contract is $12,000 and the total maintenance margin is $9,000. So when you see the table here, at the day of 7, the balance became $7,980, which is definitely lower than $9,000. So you would get a margin call from the clearinghouse to bring it back to the balance to the initial level. So you have to put $4,020 in your account, into your account. So if the futures price increases, a short trader will get a margin call from the clearinghouse, and the cash goes to the long trader through the clearinghouse. And when futures price decreases, exactly the opposite happens. And the collateralization over-the-counter market includes the trading in all securities not listed on exchange market. So parties of the contract are exposed to the credit risk since either party could default. So one of the ways to use this risk is to use collateral. Consider transactions between companies A and B, and this might be governed by an instant master agreement with a CSA, and the CSA might require A to post collateral with B equal to the value to B of its outstanding transactions with B when this value is positive. So when A defaults, company B is entitled to take possession of the collateral. Clearinghouses and OTC market. Traditionally, most transactions have been cleared bilaterally in OTC. To 2009 crisis, there has been a requirement for most standardized OTC derivatives transactions between dealers to be cleared through central counterparties. CCPs require initial margin, variation margin, and default fund contributions from members similarly to exchange clearinghouses. The left picture shows a series of bilateral agreements between market participants, while the right one shows how OTC markets operate with a single central clearinghouse. And this thing is after the crisis, and the left one is before the crisis. Okay, new regulations. Regulations require dealers to post both initial margin and daily variations for trades that are not cleared centrally. And the initial margin is posted with a third party. Okay, if a futures contract is not closed out before maturity, it is usually settled by delivering the underlying assets of the contract. So when there are alternatives about what is delivered and where and when, the party with the short position who sell the assets chooses the options. And I have two questions here on the slide. The first one is, when a new trade is completed, what are the possible effects on the open interest? So there are basically three scenarios. The first one is this completed trade can increase the open interest or decrease it or leave it unchanged. If both parties are initiating a new position, then the open interest will increase. And if both traders are closing on existing position, then the open interest will decrease. But if the old trader simply just passes off his position to the new trader, the number of total open interest will not change. And the second question is, can the volume of trading in a day be greater than the open interest? I think it is possible if there are large number of day traders who open and close the positions within a single day. If the numbers of that day traders are large enough, more than the open interest, the number of open interest, it is possible, I guess. There are some different types of orders in the futures market. The first one is, actually it is not written here. The most basic one is the market orders, and these orders are orders to buy or sell at the best price available in the market. And the limit orders are orders to buy or sell away from the current market price. Stop loss orders are used to prevent losses or to protect profits. It's like 더 잃기 전에 팔아주세요. 이런 거요. Stop limits orders are a combination of stop and limit order. Once the stop level is reached, the order would automatically turn into a limit order. And market if touched orders are orders that would become market orders once a specified price is reached. And discretionary orders are market orders where the broker has the option to delay the transaction for the better price. Time of day orders allow investors to enter the market at a very specific time intervals. An investor looking to place an order immediately after a press conference or news release can use this kind of order to be executed to the minute following the event. Open orders are orders that remain open until they either transact or are cancelled. Fill or kill orders must be executed immediately or the trade will not take place. These are the types and the regulations of futures. This is about the regulation in the US market. The regulation of futures markets is primarily the responsibility of the Commodity Futures and Trading Commission, which is CFTC, and they are trying to protect the public interest and prevent questionable trading practices. And about the accounting and taxes, also when futures are used for hedging purposes, then gains and losses from the hedging instrument should be recognized in the same period as gains or losses from the asset being hedged. And the profits and losses from speculation should be also recognized on a mark-to-market basis. So this is what the accounting and tax treatment of the futures in the US and many other countries are trying to achieve. And this table shows the differences between forwards and futures. Okay, futures are exchange traded obligations, and they are standard contracts, and the delivery dates there are lots of delivery dates, and it's settled daily. And the futures contracts are not usually closed out prior to maturity. They are either sold or bought. And since it is using the central clearinghouse. There is virtually no credit risk. Meanwhile, the forwards contracts are private contracts between just two parties, and it's a non-standard contract, and so it has just a single specified delivery date, and it is almost settled at the end of the contract, and it has definitely some credit risk. So in this case, you have to put, the company should have some collateral or something else. And foreign exchange costs. Futures exchange rates are quoted as the number of US dollars per unit of the foreign currency, and forward exchange rates are following this procedure, but such as currencies other than pounds, euro, Australian dollars, or New Zealand dollars are quoted as units of the foreign currency per dollars.
The compensation to the risk, right? Do you remember? And there are many that kind of strategy. And then today we'll talk about the limit of that kind of strategy. If you go to industry, you will listen many people say a lot of trading ideas. They are basically, trading ideas is basically list of stocks to sell and list of stocks to buy basically. And then about today's paper that I introduced, it tells about very interesting perspective to assess that kind of trading ideas. So I think it is a very highly practical paper. Yeah. Most of you, I think some of you may be interested in academic ideas. I'm more interested in academic ideas than practical ideas, which is more tangible, close to making money. Anyway, since I guess you are more interested in the later part, more tangible, practical idea, so I picked those papers. The examples is low volatility anomaly. Let's download this. The limits to arbitrage and the low volatility anomaly. Forthcoming in Financial Analyst Journal. This is academic paper. If you go to PhD program or graduate program, you have to produce something like this, which is called dissertation or thesis. Let's read the abstract together because it gives us broad idea about what this paper is about. We show that over a long study period, the existence and trading efficacy of the well-known low volatility stock anomaly. So it is some kind of strange phenomenon about low volatility stocks. Okay, are more limited than widely believed. For example, we find that the anomalous returns are not found within equal weighted long-short portfolio. So like a tax surprise idea we discussed last week, it is also kind of anomaly because the standard efficient market hypothesis and risk model cannot explain. So it is also tax anomaly. Right? Today we will talk about low volatility anomaly. Anyway, within a value weighted portfolio, the existence of the alpha is largely eliminated when omitting low price less than $5 stocks. Furthermore, extracting any excess returns associated with a long-short portfolio is meaningfully hampered by high transaction costs, reflecting the finding that the abnormal returns are concentrated among low liquidity and small stocks. Okay, so there is a strange phenomenon called low volatility stock, and that the authors argue that that phenomenon is concentrated in low liquidity and small stocks. Okay. Adding to the challenge, the anomalous excess returns quickly reverse, requiring traders to rebalance quickly in attempting to extract profit, thus amplifying liquidity needs. Our findings have meaningful implications for those attempting to implement low risk equity portfolio strategy. Low risk equity portfolio strategy or low volatility stock anomaly is actually, it was quite a fad in 여의도 last year. I'm not sure whether it's still fad. In 여의도 it's called like 저변동성 주식. At the time it was very like trend to make products out of 저변동성 주식 because they believe 저변동성 주식 is good. And that talk in the industry is direct application of this low volatility stock anomaly. This paper argued that there is something wrong about that 저변동성 주식 선호 현상, something like that. Something wrong about low volatility stock anomaly and people's attempt to make money out of that. Let's go more specifically. In what is sometimes referred to as the low risk, low volatility anomaly, researchers have discovered a provocative empirical inverse connection between future stock returns and various measures of stock return variability, including total return volatility, idiosyncratic volatility, and beta. First, total return volatility is just like standard deviation. We can like measure standard deviation of daily return over last 1 month, right? That is like total return volatility of individual stocks. Similarly, we can calculate idiosyncratic volatility. We apply like a capital asset pricing model or Fama Francis 3-factor model, and then there is residual term, right? And we collect residual term, and then we calculate standard deviation of it, and it is idiosyncratic volatility, and sometimes we beta. Low risk anomaly, the provocative empirical inverse connection is that it says that if a stock has high variability, so high variability, like high standard deviation, future stock returns are low. Okay, high variability. So we calculate variability based on past 1 month. Some stock moves like this, high variability. Some stocks move like this, small variability. And this low volatility anomaly is the stock with a lot of fluctuation predict lower future return. Why is it provocative? Why it is strange? Any guess? Do you think it is natural pattern? Nothing wrong with that, or something strange about that? How do you think? 이미연 학생, how do you think? 뭐가 이상한 것 같아요? 제대로 된 것 같아요? In this article, we seek to further explore the anomalous low risk return in an effort to better understand the underlying economic question of why 저변동성 주식 outperform. Okay, why is that? Of course, they fail to answer this question, but they have interesting idea. We examine what role portfolio rebalancing and transaction cost play in attempt to extracting the profit from the low risk anomaly. So they investigate a strange pattern from the perspective of actually implementing the strategy that you just told, 수연 just told. Okay, buy low volatility stock and sell low volatility stock. But in order to do that, there is maybe some transaction cost, right? Whenever we buy and sell, there is transaction cost, and then there is maybe need to rebalance portfolio from time to time. Whenever we rebalance, there is a transaction cost. So the authors examine, okay, that basically anomaly and then trading strategy from the perspective of rebalancing and transaction cost. Interesting, right? To highlight their finding, they find that the excess return associated with forming the low risk zero cost portfolio. Zero cost portfolio is that we buy low volatility stock and sell exact dollar amount of high volatility stock, then buy and sell side is exactly the same. So the value of the net value of the portfolio is zero, right? Long position, short position is same. So it is zero cost portfolio. So it is extreme betting. Betting on low vol and then betting against high vol, right? Exactly the same amount. Okay. That profit is short-lived. Okay, as they are present only in month T plus 1, only 1 month. The profit lasts 1 month, which means that they have to rebalance portfolio every month. And then whenever every month they have to rebalance, and there is a transaction cost. And then furthermore, such transaction costs remain valid only 1 month are largely subsumed by high transaction cost. Okay, so it means that basically that trading strategy is useless. Furthermore, we find that the anomalous returns within value-weighted portfolios are largely eliminated when omitting low-price penny stocks, and are not at all present within equal-weighted portfolio. Interesting, right? 예, 이런 것들 페니스탁, 싼 주식을 페니스탁이라고 불러요. 네, 페니스탁. 네. 내가 울프 오브 월스트리트 보라 그랬는데 본 사람. 다 아직도 안 보는 건가? 본 사람이 한 명도 없나? 예, 꼭 보세요. 거기서 이제 디카프리오가 블랙 먼데이 때 해고당하고 나서 처음 이제 시작한 비즈니스가 아주 허름한 데가 이제 페니스탁 비즈니스라면서 울프 오브 월스트리트. 아주 재밌는. 어쨌든 그 부분 나중에 설명하기로 하고. Of course, in the academia, we had a theory. There was a theory about the idiosyncratic risk and the future returns. If market is complete, I mean perfect market, idiosyncratic risk shouldn't be important about return, right? In the last class, I told you only beta determines future expected return, right? The volatility of idiosyncratic part doesn't affect future return in ideal world. In 투자론 재무관리 class, the reason is that idiosyncratic risk goes away if you have large portfolio, large diversified portfolio, right? So therefore, it is such a easy to get rid of that idiosyncratic risk. Idiosyncratic risk shouldn't matter in ideal world. But so life is not that ideal. Merton noticed that Merton offers an explanation for why investors would demand higher return for taking on high volatility stocks. He explains that the IBOR would be positively related to expected return when investors cannot fully diversify their portfolio. So different from textbook, since we cannot diversify our portfolio completely, idiosyncratic may matter. So if a stock has high idiosyncratic risk, it makes me more risky. So we have to expect high expected return, right? That's the common sense. But then it is exactly the opposite of low volatility anomaly. Right? If Merton is right, low volatility anomaly should not happen. Right? Low volatility should generate low return, and high volatility stock should generate high return because of risk return related. Right? So this Merton's explanation is intuitive, makes sense, but exactly opposite of what we observe. And then there are people who try to explain low volatility anomaly, like Ang et al. Find the existence of eyeball anomaly in numerous countries. They find low volatility anomaly is in Korea. I cannot find in US, in Europe, in Japan, many countries. So low volatility anomaly is not single country phenomenon. It is global phenomenon. In addition to that, okay, they argue that such an effect could be driven by latent systematic risk. So it is true that low volatility stocks generate high return in every country, but interesting part is that may capture some underlying systematic risk that affect every stock in the world. Because it affects every stock in the world, we cannot diversify it, right? Like beta in the capitalism price model, market risk. So even though this relationship looks like relationship between idiosyncratic risk and future return, they argue that it is actually relationship between more fundamental systematic risk and the future return. They try to reconcile our standard finance theory with this weird, provocative phenomenon. Specifically, they show that abnormal returns generated by idiosyncratic volatility-based portfolio strategies in international markets strongly co-move with those in the U.S. market, which suggests that, well, such low volatility anomaly, which exists in every country, and they seemingly move together. Because they move together, there is some hidden factor that may move everything together, and then must be systematic factor. This is their thought process, suggestive of common risk factor. They state that the large commonality in curve movement suggests that broad, not easily diversifiable factors lie behind this effect. The core movement finding suggests that the return predictive power of idiosyncratic risk is likely due to some pervasive risk factor which we don't know yet. Clark et al. As well argue that IVOR should be seriously considered as an additional equity market risk factor that investors should incorporate in portfolio construction. Interestingly, however, this kind of low volatility anomaly is exactly counter to the Merton's prediction. So this is still open question. Why there may be some systematic factor, but why it is inverse relationship? Why the direction is okay? There may be some systematic factor, but why the direction of the systematic factor is exactly opposite of the Merton's prediction? That's still open question. Though his focus was on market beta, Black offers a related, theoretically consistent interpretation. Black tries to answer. Black offers some related explanation. Why low risk stock might do so well relative to high risk stock? He shows that borrowing restriction. Okay, in order to invest in stock, we have to borrow money, and there is a restriction in borrowing. Borrowing restriction such as margin requirement might cause low beta stock to outperform. Okay, so outperformance of low risk stock maybe is a consequence of borrowing cost, because we can save borrowing cost. That's what makes the return higher. One explanation. More recently, Wiggler et al. Proposed behavioral consideration. They argue that, well, maybe there is non-rational behavioral pattern of investors which generate low volatility anomaly, including the structure of institutional client mandate, discourage arbitrary activity that would otherwise eliminate the low volatility effect. The Black and Wiggler et al. Explanations may provide insight into why the low volatility effect continue to persist for so many years despite being highly recognized. It has been, this effect is strong, low volatility effect is strong, highly recognized, and making money out of the anomaly is such an easy transaction cost, as you said, right? So it is like $1 in the table. It's like $1 in the table for a long time. The question is, why someone goes and grab the money? Why the money is still there? That's a question, right? That doesn't make sense, right? There is free money on the table. Everyone can grab it. But why it is still there? It's an open question. It is such a long, the pattern exists such a long time, and it is such easy to make money out of it. But why it is there? If everyone tries to make money out of it because of competition, that should go away. But why it is still there? Now, data and sample. This is their theory. Basically, there is no theory, but they try to reconstruct using data. They reconstruct the pattern. We concentrate on idiosyncratic risk measured relative to pharma franchise factor model. Okay. Specifically, we measure IVOR as the standard deviation of the residual from pharma franchise factor model, regressing the daily return of the individual stock in excess of the past 1 month, in excess of 1 month TV rate. This one is this part. On the daily return to the common factor relative size of the market. In other words, for every stock, they perform this kind of regression analysis. And this is excess return over risk-free rate. And then they control market factor, size factor, value factor, and then this A is, as I told you last class, it is, if it is positive, it is like pure money. Compensation is money beyond the compensation to risk, right? The pure part, and this one, okay, this part is residuals, okay, residuals that risk model cannot explain. So basically now they are interested in this part. They collect this one of each stock for the last 1 month and calculate standard deviation of it. And they call that as a variability. So if this moves a lot, it means that stock is high vol stocks. If this one moves something like this, it's low vol stocks. And then, so they use a daily return. So this is their IVOR, okay. And then they also define IVOR 36 and IVOR 60, okay. IVOR 36, IVOR 60 is the, because they try to do, they want to show their result in many ways. So in the previous case, they use daily return for monthly period and calculate IVOR volatility. And then in this case, they use monthly data for the last 36 months, 3 years. Or they use the 60 months for the last 5 years. And using monthly data, they can again calculate the idiosyncratic volatility. And they call that as IVOR 36, IVOR 60. And then also they use beta, capital asset pricing method beta. And so they define variables in many ways. But basically, stock with this movement is high IVOR stock. Stock with this one is low IVOR stock. It is the way of defining the extent or degree of this one, right? Next, they explore the efficacy of the IVOR trading strategy. IVOR trading strategy is what Suyeon described: buying stock with low IVOR and selling stock with high IVOR. Right? That's IVOR trading strategy. Here the IVOR is the extent of this one, as I told you. There's like 4 ways in the, until now there are 4 ways of calculating IVOR: daily return, 36 monthly return, 60 monthly return, and beta. Okay. Anyway, IVOR. We explore the efficacy of the IVOR trading strategy using several empirical measures of the liquidity. They basically use 4 measures of liquidity. Measure number 1. For our first measure, we use the average stock price per share So basically stock price in the month prior to portfolio formation. Why? Because it is well known that stocks with a market value of less than $5 per share, or so-called penny stocks, possess meaningfully less liquidity for trading purposes and are subject to market manipulation versus non-penny stocks. So it means that they argue that cheap stocks are basically less liquid. But it is kind of contrary to our, again, common sense. We usually think that expensive stocks are harder to trade. Always is a like cheap stock, a cheap product, right? But in stock market it is different. In stock market, expensive stocks are easier to trade, more liquid. We say, why is that? Why? Why in stock market more expensive stocks are like easier to trade? Actually, they are cheaper to trade. Why it is cheaper and easier to trade? Why? Because trading involves fixed cost. When we buy sell, we have to pay tax, and whenever we buy sell, there is a bid-ask spread, right? So we pay commission based on number of stock, not the value. So for cheap stock, that part of the transaction cost have a high fraction. Again, Wolf of Wall Street, when Leonardo DiCaprio figures out that basically he called client of the penny stock, and they want them to buy stock or sell the stock, generate trade flow. Thing is that whenever he recommends client to trade, he takes out, like whenever per dollar, he takes out 25 cents per trade, right? 25%, $1, so 25 cents per dollar, which is huge, right? Every dollar trade, they take away 25 cents. Leonardo DiCaprio got 25 cents, which is huge. But if that stock is like $1 million stock, then 25 cents is nothing, right? So even Leonardo DiCaprio was surprised at the movie. What, 25 cents? That's amazing way to make money. Something like that. This is one. So how expensive is this? Okay. Second liquidity measure, we proxy transaction costs such as bid-ask spread and commission as the proportion trading days. So second measure is the trading days with non-zero returns. Why is that? We measure the incidence of a non-zero return. Non-zero return means that stock price moves. If it moves, if it is either positive return, negative return, right? If it is zero return, it means stock price doesn't move. So basically, we simply count number of days the stock price movement is not zero. That is a non-zero return. Why is that? We measure the incidence of non-zero return as a percentage of days during the prior month that a stock experiences a non-zero return, non-zero. The idea behind the non-zero is that a security with a high transaction cost and thus low liquidity will have less price movement and therefore more frequent zero return days than a security with low transaction cost and thus higher level of liquidity. It makes sense, right? The underlying premise is that the marginal trader will only trade when the marginal benefit of information signal exceeds the cost of trading. Otherwise, the security experiences zero return, right? Only when we have more benefit than not trading, right, we will trade, right? If it is easy to trade, they are more likely to trade, then it will make more likely to deviate from zero return, right? Anyway, in short, non-zero will take on a smaller value for low level of liquidity. Makes sense, right? Now, third measure is more conventional. It's basically trading volume, how active a market is. For our third liquidity measure, we proxy for the ease in which arbitrageurs can accumulate and liquidate trading positions. Okay, here we use a dollar volume, D-vol, okay, dollar volume, defined as a product of daily closing share price and share volume. If there is active market, it's more liquid, right? It is easy to sell or buy. So it is the usual, very popular measure of liquidity, if whether there is a lot of trading volume or not. Okay. Now, finally, fourth measure of liquidity, which is my favorite, which is called Amihud illiquidity measure. Amihud illiquidity measure looks like this. T is the given period in which there was a trading volume is positive. Positive T is the number of days in which trading volume is positive. And over the time period T, specific time period T, Amihud suggests us to calculate this formula. And if number is high, this number is high, then the stock is illiquid. If the number is low, then a stock is liquid. This is very popular. Well, T is the positive volume trading day. Within the month, the measure is calculated. Note that a high value of Amihud signifies high illiquidity because a particular dollar volume traded is associated with a relatively high price movement. Right? We calculate all our measure of expected trading cost during the same month in which IBOR beta is measured. Right? Again, we go back to Amihud measure. I mean, so if we look at this, then price is fixed, so there is a volume and return, right? So if this is large, trading volume generates a lot of movement, right? For example, whenever I try to buy some stock, if market is illiquid, because of my demand, stock price will go up, right? Because it's positive demand shock, right? If that movement is large, it means that my order generates more market impact. In the very liquid market, that kind of market impact should be very small, which means that this Amihud measure should be low. On the other hand, if Amihud measure is low, whenever I try to sell something, because my selling volume, okay, market price will go down a lot, right? Again, huge market impact, which is low liquidity. So this is very intuitive. This is very intuitive formula to measure market liquidity. So, okay, we have basically four ways of defining variability: IBOR, high IBOR, low volatility, and we have four ways of defining how liquid the market is. So our next strategy is basically we check the transaction cost, we check the trading strategy involving high IBOR and low IBOR stock, and for each trading for that trading strategy, we analyze that trading strategy based on these four measures of the liquidity. That's our next step. Let's take 15-minute break first. 잠깐 질문까지 받고. 네. 그러니까 이게 크면 클수록 삼성전자, 코스닥 이런 걸 계산하고 이게 크면 클수록 리퀴디티가 떨어진단 말이에요. 내 생각엔 꼭 그렇게까지 안 해도 되는데 수업 들으면 끝나는 걸 뭐 친구들끼리 모여서 그런 거 하루 하고 그래. 약간 시간 낭비. 배우면 알겠지만 뭐 배우겠지만 진짜 쉬운 거거든. 고등학생도 할 수 있거든. 고등학생도 할 수 있는 거거든. 바이노미얼 트리는 중학생도 할 수 있는 거고 요즘 대치동 초등학생도 있어야 돼. 바이노미얼 트리는 초등학생도 할 수 있는 거고 중학생도 당연히 할 거고 블랙쇼딩 모델은 고등학생들도 할 수 있는 거고 굳이 대학생들 고급진 애들이 모여서 친구들끼리 시간이 필요한데 그 시간에 근육이나 만들고 진물이나 뭐 이런 거 있잖아. 그게 좀 더 생산적으로 시간을 쓰는 것 같아. 그러면 이제 수업 시간이 있고 모르겠어요. 그게 근데 재밌어서 그게 너무 재밌는데 운동보다 더 재밌어요. 여가로 한다면 할 만한 겁니다. 어쨌든 테이블 1을 보도록 하겠습니다. Let's take the table 1. 아까 크롬을 내가 닫아버렸어. Summary statistics. So we have eyeball 36, eyeball 60, and beta. Okay, they are all measures for variability, and average non-zero amplitude trading volume and price. They are measure of the liquidity. Some interesting pattern is that okay, we have 4 measure of the liquidity: price, non-zero, amplitude, and then this part is about correlation. And the correlation between those 4 shows that they are not that strongly correlated. Very interesting, right? They measure all liquidity, but they are not strongly correlated, which means that liquidity is maybe multi-dimensional concept, not a single concept. It is a collection of many things. So we have 4 ways of measuring liquidity, and they include all different information. That's interesting. The table 2. Table 2, from table 2 now we have an important result. Table 2 is abnormal returns for idiosyncratic volatility based portfolio, monthly regression of eyeball quintile portfolio returns. So this is quintile, so 5, okay? 5 portfolio returns. Table 2 reports the coefficient estimate for the intercept of the Fama Frenchy 3-factor model in percentage. Those number, okay, are all the number is basically, okay, so it is excess return. I drop the P, risk-free rate, market, MKT, is the market return minus risk-free rate. Small form minus large form. Gross value form minus gross form. So this is pure money. Return beyond compensation to the risk. So all numbers in the table are that intercept term alpha. Okay, actually I need a 3-factor model in percentage. So it is percentage term. The dependent variable are the monthly excess return. So this term, this thing in the left hand side are dependent variable. Are the monthly excess return now value weight quintile portfolio. The value weight. So it is like we assign more weight to the Samsung Electronics and small weight like Kosdaq stock. Formed monthly. So every month we form the portfolio assigning formed into quintile based on the magnitude of eyeball. Okay, eyeball is measure of variability. So every month we measure eyeball for each stock and then sort, and each stock we have to send one of 5 group, 20, next 20, and bottom 20, 5 group quintile. And then how we calculate the eyeball variability. Eyeball is computed monthly as the idiosyncratic volatility in the regression of daily excess return on the Fama Frenchy 3 factors. Okay, minimum of at least 17 observations. Okay, so it is we calculated eyeball based on monthly data. Actually, same model, okay, for each one. We relate eyeball in month T with the stock return in future months. Okay, so future months. So every month, okay, every month we calculate this, and then, okay, we relate the future months. Okay, month T plus 1, month t plus 2, month t plus 3, month t plus 12, which means that again every month we run this regression, and for each stock we calculate this one, and then we classify stocks 5 group, and for each 5 group we run the regression of this one again from this month. Now it is future. In the past data we calculate this, and then based on sorting, now future for each period. For the next 1 month we run that regression again and then calculate alpha. And then from this month to 2 months, without changing portfolio weight, exactly same 5 quintile, we wait and see what's going to happen next 2 months, next 3 months, and next 1 year. Basically, we are tracking long-term performance of each quintile. Okay? Stock returns adjusted for, of course, dividend and delisting returns are from CRISP. Now 1, this rank 1 corresponds to quintile funds with lowest variability, 저변동성 주식. 5 corresponds to highest 고변동성 주식. 1 is different portfolio between lowest and highest ranked quintile portfolio or quintile spread portfolio, long short portfolio. 저변동성 주식의 long position, 고변동성 주식의 short position. Okay? Heteroscedasticity constants and t-statistic measuring the significance of excess return are important. It is just a cool way of calculating z-value. In standard normal distribution, z-value is like when g is 1.9, it is like 95%. You remember? When g is like 2.33, it is 99%. Something like that. It is just a cool, rigorous way of calculating that thing. Okay? All numbers in parentheses are that t-value, heteroscedastic constant. When if it is greater than 2, it is good. Okay? We just check whether it is greater than 2 or not. 3 star, 2 star, 1 star indicate that they are significant at 1%, 5%, 10% levels. Okay? Now this table is highly interesting. Okay? Let's take a thought. We formed the portfolio this month based on 1 month data, and from today to next 1 month, what's happening is that rank 1, 저변동성 주식, low vol stock is positive, 고변동성 주식 is negative. So it is exactly ordered. High, next high. This is slightly higher than this was strange, but low, right? So it is ordered. It is a well-known low volatility anomaly. High risk, low return, right? And if you take long short portfolio, take long position of this one and short position of this one, it is 1.19% per month. So it is more than, it's almost 13% per year. Significant 3 stars. Okay, number is greater than 2. But then strange thing is that after month, so next month we wait and see what's going to happen for the next month. Next month thing is that okay, this one is positive, but this one is more positive now, and this one is even more positive, and now these two things becomes insignificant. So now order is becoming mess. It is not well ordered, and high volatility stock does not generate negative return anymore. Okay, of course the gap between this and this one is still positive, but the size is just half. It means that our trading strategy buy 저변동성 주식 and selling 고변동성 주식, that volatility based strategy doesn't last more than once. 유효 기간이 1개월이라는 거지. It's valid only 1 month. And from monthly, it is even worse, right? 5 and increase in this, not significant, right? The difference between these two is not significant. After 1 year, almost completely disappears. Difference in this is just 6% and not statistically significant. It means that in order to make the validity, the trading strategy remain valid just 1 month, which means then in order to make money, we have to trade every month. right? because 유효기간이 6개월이니까 1개월마다 갱신을 해야지. So what we have to do is every month, again, we have to calculate IBOR, and then we have to sort the stock, and we have to make 5 groups again. We have to do it every month in order to make money. Okay? That's a bit annoying because if we have to do it every month, it means that we have to pay transaction cost every month, and if the transaction cost is high, we cannot make money. Net money, right? That's the problem. Okay. So that was the table 2, right? Table 2. Right? So empirically then the excess return action surrounding the IBOR anomaly all occurs in the just first month, or possibly 2 following portfolio formation, just 1 or 2 months. Okay? So 유효기간 is very short. In short, we find that the IBOR effect is short-lived, effectively requiring traders to adjust portfolio holding at least every other month to have a reasonable chance at producing alpha. Such frequent rebalancing naturally raises the question about the impact of a transaction cost and liquidity constraints, right? Because we have to do every month, rebalance every month. It worries. We have to question the impact of transaction cost and liquidity constraint. Now we have 4 measures, right? Now it is time to kick in those 4 measures of liquidity in this analysis. Table 3. Table 3. Abnormal returns for low risk-based portfolio. Okay. Again, table 3A is similar. Table 3A reports the coefficient estimate for the intercept. Again, the same intercept of the Fama-Francis 3-factor model in percentage terms. The dependent variable is same. The monthly excess return of the equally weighted and value-weighted quintile portfolio formed monthly by assigning funds into quintile based the magnitude of respective risk characteristic. Now we have 3 measures: IBOR, IBOR 36, and beta. Okay, we relate each risk characteristic in month T with the stock return in future months. We are gonna what's gonna happen next month, and next month. Okay. Stock returns adjusted for dividend and delisting returns are from CRISP1 is name of the database. Again, 1, 5 corresponds to the quintile form with the lowest or highest risk characteristic. 1 minus 5 is the difference portfolio between the lowest and highest ranked quintile portfolio or quintile spread portfolio. Again, we calculate number based on heteroscedastic consistent t-statistics, just a cool way of calculating c-value. Measuring the significance of excess return are in parentheses 3 star, 2 star, 1 star, which is 1%, 5%, 10% significant interval. Let's look at this. Okay. This number is exactly same to the numbers in previous page. So in the valuated portfolio, once we take a long short position of the 저변동성 and 고변동성 stock, our return in the first month is 1.19%, right? This is same to this one, 1.19%. Next month is 0.77%, which is this number. Third month is this one and this one, 0.39 and 0.06, right? Exactly this number, right? And it shows that our trading strategy upon valuate remain valid only 1 month or 2 months possibly. And then if we use equally weighted portfolio, exactly same dollar for Samsung, same dollar for Hynix, same dollar for Costa, this trading strategy even shorter lived, just 1 month, and it is just 10% significant, right? It's very weak. From second month, the effect completely goes away, right? And let's look at this one. Let's use a different definition of IBOR based on monthly return. Well, the result is even weaker, right? Now, even in the valuated portfolio, so we can make profit only first month. From second month, the profit is not statistically significant. Same with equal weight, it is even weaker. If we have this definition of beta, this is significant now, this will completely goes away. Okay. Across all analysis, it shows that our result is valid for only 1 month. So every month we have to rebalance. Now, second, now let's get rid of the penny stock that Leonardo DiCaprio is interested in. Okay. If we get rid of those penny stock, what's happening is that in the equal way, now we have negative sign, all strongly significant, which means that negative means that 고변동성 주식 generate higher return than 저변동성 주식, which is not surprising at all, right? Not surprising. High risk, high return. Not surprising. Across all periods, they are all significant. Not surprising. If we exclude those penny stocks, okay, then this value-weighted portfolio remains valid, remains strong only first month, and the size is just 0.38, which is less than half of the previous case. Actually, 1/3, almost 1/3. And then from second month, profit completely goes away. If we take a look at the first definition of variability, IBOR 36 beta, again, they are all negative. High risk, high return, not surprising at all. This was no star, insignificant. It means that, okay, so this table shows that more than 1 month, the strategy doesn't make money. Second, if we get rid of cheap stock, penny stock, that strategy doesn't make money at all. Which suggests that, okay, the low volatility anomaly is concentrated on the very first month of penny stocks, right? So it is penny stock driven short-term phenomena. Does it make sense? Any question? 질문 있어요? 질문? 예. 그러니까 정의가 뭐냐고? 그러니까 밸류에이션 그거지. 얘가 포트폴리오를 만드는데 삼성, 하이닉스, 코스닥 주식 3개를 가지고 있다. 그러면 이퀄웨이에서는 똑같이 1달러씩 투자하는 거고, 밸류에이션 삼성이 훨씬 크잖아. 큰 회사한테 돈을 더 많이 집어넣는. 그래서 코스피 200이 있잖아. 코스피 200은 이퀄웨이션. 200개 우리나라 주식에 똑같이 돈을 투자했을 때 나오는 수익률이라고 생각하면 돼. 그에 비해서 종합주가지수는 밸류웨이션이에요. 종합주가지수는 마켓 웨이트, 엄밀히말하면 플로딩 웨이트라고 부르는데 그건 나중에 될 필요 없고, 큰 회사의 정도 웨이트 말고. 그래서 삼성전자가 한 번 움직이면 확 움직이고, 삼성전자가 한 30% 거의 집어넣고, 코스피 200은 안 돼요. 삼성전자 아무리도 똑같은 입금에 묻잖아요. 그래서 또 다른 세 번째 결론은 그거지. 내가 넘어가려고 했는데, 로우 발로틀리티 어너머리는 밸류웨이트 포트폴리오에서 시그니피컨트하게 나타납니다. 그거에 대해서 왜 그런지 케이스는 설명을 안 했어요. 어쨌든. 또 질문. So first, results for average alphas are somewhat weaker when using equal weighted portfolio. A finding consistent across all time period and across all risk definition. The observed zero cost alpha monotonically declines rapidly during succeeding months after portfolio formation for all measure of risk. Current month's risk has no meaningful relation with the stock return in period beyond the second month. Third, our alternative definition of volatility, IBOR 36 beta, generally presents somewhat reduced average alpha versus IBOR for both value-weighted and equal-weighted portfolio. So when we exclude penny stock, when excluding penny stocks, one proxy indicator of liquidity, portfolio alpha is meaningfully reduced across the board. That is, for all risk measure, formation periods and holding period. 그렇죠? 다음 테이블 4로 들어가서 한번 보겠습니다. Next table. 테이블 3B 뭐 이런 거고, 네, 이건 넘어가도록 하고, 네, 이건 그냥 피리어드별로 이렇게 본 겁니다. 그래서 평균을 내서 기간별로 나눠서 본 거죠. 기간별로. 네. So it is 기간별, 기간별 결과. 기관별보다 interesting finding is that the lower effect in if we take the value-added photo which generates stronger profit, that lower effect doesn't present in the 1991년부터 2007년도까지는 존재하지 않는다는 재미있는 결과가 또. Table 4. Table 4 numbers are same. Okay. So again, Table 4 reports again the same coefficient estimate for the intercept of Fama-Franchi three-factor model. Here, alpha terms are in the table. The dependent variable are the same monthly excess return of the value-added quintile portfolio formed monthly by assigning funds into the quintiles based on the magnitude of IBOR. And the IBOR is computed monthly as an idiosyncratic volatility in the beginning of a daily excess return on the Fama-Franchi three-factor. Minimum of 17 observations. Same. We relate IBOR in month T with the stock return on month T plus 1. Okay, so now we focus just 1 month, strong 1 month performance. Stock returns are adjusted. 1.5 corresponds to quintile formed with the lowest IBOR and highest IBOR. 1 minus 5 is difference portfolio between the lowest and high ranked quintile portfolio, quintile spread portfolio, and then number there again the cool T statistic. Okay, now the average price is the average daily stock price in month T. Average non-zero R is average proportion of daily stock return that are not zero in month T. Average DVOR is the average of monthly sum of the trading volume. Okay, daily products of closing price and share volume. Average Amihud is the monthly average of Amihud measures. Okay, so this one shows that. Okay, this is rank 1. Okay, low 저변동성 주식, high 변동성 주식. If we, as we move from low vol stock to high vol stock, average price declines. Okay, which means that as we move from low vol to high vol stock, liquidity declines. Okay, average non-zero R. This one doesn't show any pattern. Okay, but again, average Amihud as we move to the high vol stocks, okay, high vol stock, Amihud number becomes bigger and bigger, right? Again, high vol stocks are kind of low liquidity stock, and the average trading volume becomes smaller and smaller. Again, it means that high vol stocks are low liquidity stock. So except non-zero measure, all three liquidity measures tells exactly same information. As we have moved high volatile stock, they are less liquid stock. Okay. As for this one, it is kind of understandable because the definition of this one is this stock like a small moving, low variable stock, large variable stock. So by the exact definition of construction, way of construction, this stock is likely to move. Therefore, they are likely to include stock with more zero returns, right? By construction. So in some sense, this is not surprising. Okay. Again, this is number of days with no movement, right? Number of days for no movement, and this is the sorting based on small movement, right? No movement is still small movement, right? Therefore, sorting based on this one include those two effects, so it is not surprising that this is not sorted. 그렇겠죠, 논리적으로. 질문. 그래서 overall, our findings suggest a close positive association between IBOR and illiquidity. Right? Interestingly, we find an average price of 7.03 for those stocks in the highest valued quintile, which is that many stocks in the highest quintile portfolio would be considered penny stock. So it means that actually many high volatile stocks are actually penny stock. In this table, it is $7 because we exclude stock, because we exclude penny stocks. But actually on average is $5, so it is like penny stock. $7. So okay, actually, sorry, it is $7. It is $7. It means that most of stock here is like penny stock. More than half is actually penny stock. Now we can go to table 5. Table 5 is that abnormal returns for idiosyncratic volatility based portfolio, monthly regression of IBOR, quintile portfolio returns. Okay. Table 5 is similar to table 4 but exclude penny stock, and then excluding penny stock we have a similar result. Sorting, this is decreasing, this is increasing, and this is decreasing. Okay. Even without penny stock, they all has existed same information. 고변동성 주식, high volatility stock, illiquid stocks. In table 5, the every alpha for zero cost for declines meaningfully to 0.38% from its earlier average value 1.19%. Now table 6. Okay, I think table 6 is the less interesting. Table 7 is less interesting. You can go over table 6 and 7, but they are basically the same information. Almost same information as the table 5. So let's go directly to conclusion discussion. I think this discussion part nicely summarizes the whole idea of this paper. So I think it is a good idea to read this one together. So in our exploration of the low risk anomaly, over the full study period, we first find that the various IBOR-based trading strategies we test are profitable for value-weighted portfolio, not equal-weighted portfolio, only with frequent rebalancing, and are not profitable at all on average when using beta as a measure of risk. Okay, so it means that our 저변동성 주식 현상, right, low volatility stock anomaly, is sensitive to the definition of how we define this variability. Now, holding period beyond the first month produce little or no discernible alpha effect. Right? So, you got 1 month. We further find that for the monthly IBOR-based rebalanced value-weighted portfolio, where portfolio alpha lies, the profitability of a zero-cost IBOR strategy is reduced by 60% or more in the subsample of stock with relatively low transaction cost and high liquidity. This is in contrast to finding of Ang et al., who find that transaction costs have little impact on alpha, although they do not concentrate the penny stock. It means that basically their previous analysis is wrong. Now the authors further find that since 1990, the alpha associated with the low risk effect for valuated portfolio has disappeared within the most liquid universe of the non-penny stock. Specifically, in unreported results over 1991 to 2010, we find an insignificant zero cost portfolio abnormal return of this one. So they argue that, well, many people believe that low volatility anomalies are present, but they find that pattern actually disappeared after 1990 with alternative data analysis. Additionally, when exploring equal weighted portfolios over all sample periods, we find that any alpha associated with the low risk effect is also completely eliminated within the subsample of stock with ample liquidity for trading purpose. Now, the combined evidence from our measures of liquidity consistently suggest meaningfully higher cost for arbitrageurs in attempting to exploit the low risk anomaly. In short, our finding cast some doubt, actually not some doubt, serious doubt, right? Serious doubt on the practical profitability of low risk trading strategy. 그러니까 여의도에서 작년에 보던 현상은 우리가 상당히 의심을 해봐야 되는데, 과연 이런 분석을 실제로 해보고 그렇게 고객들한테 저변 주식을 팔려고 할 것이냐 생각을 해봐야 됩니다. For all these reasons, Our results lead us to conclude that the documented 1-month low risk trading strategy has continued to exist to some extent due to the existence of significant barrier to the arbitrage, including transaction cost and illiquidity cost. So it means that dollar is on the table because no one cannot grab it. It is too expensive to grab the dollar from the table. So it is their argument. But again, they fail to explain why the dollar is there from the beginning, right? They argue that what they find is that dollar is there, even though everyone can see that dollar on the table, the dollar is there for the several decades, right? They find that it is expensive to actually grab the dollar, but they cannot explain why the dollar is there from the beginning and why the specific amount of dollar is there. Okay? They cannot. It is still open question, I think. If we have an idea why dollar is on the table as a form of 저변동성 지수 현상, please let me know. It would be interesting. This cost constraint, right, consider arbitrage from fully eliminating the anomaly return, fully take away the cash under the table, on the table. Finally, the findings presented in this paper not necessarily preclude the possibility of profitable strategy associated with low risk preference. So they admit that maybe there are smart other strategy to make money. It is possible. Okay, they don't. Of course, it is impossible to check every possible strategy involving low volatility phenomenon, right? That's impossible. They just attack just one very most intuitive strategy, but not the most sophisticated strategy. Clearly, there are other potential approaches to capture the low volatility effect, which may prove constructive in abstracting abnormal returns. Okay? However, of course, they have to defend their paper. However, our paper is comprehensive in its measure of risk, and as such, it certainly raises important issues about implementing a successful low-risk arbitrage strategy in U.S. equity portfolio. We look forward to more research on this. Good. It's a very simple situation. Okay. slideshow. 현재 슬라이드부터. Stock price is currently $20. In 3 months, it will be either $22 or $18. Don't ask me why. It is just assumption. In addition to that, when actually implementing binomial tree, it is very easy to estimate. Actually, it estimates 22 and 18. So at this point, you don't have to ask where this number from. Okay, not important. Okay. So anyway, there are two scenarios: go up or go down. Stock price 20. Any question? Very simple, right? And then there is a call option such that when prices go up, that derivative pays $1. When stock price go down, that derivative pays 0. This kind of contract is called call option. Okay? Call option with stock price of $21. The call option means we can sell a stock at $21. If stock prices go up, option to buy. It is a right to buy stock at $21. So when stock price is $22, we can buy $22 stock at 21. Come back home anyway at 21. So it is we can make $1 profit, right? But when stock price is 18, it is stupid to buy $18 stock with 21, right? Doesn't make sense. So we don't exercise the option, so it is $0. So anyway, it's call option or whatever. When stock prices go up, $1, down, $0. Then our question is, okay, if there is a contract, financial contract, that pays $1 in scenario 1 and $0 in scenario 1, Then what is the value of that financial contract? Financial contract. That's the fundamental question. What is the option price? What is it? 수업 들었으니까 한번 이야기해보지. 어떻게 구하면 돼요, 이럴 때? 얼마인지 알고 어떻게 해요? 여기 친구들이랑 했다며. 한번 설명을 해봐. 어떻게 하면 돼요? 확률. 오케이, 확률. 무슨 확률을 알아야 돼? 두 개밖에 안 해서 이걸 P라고 하고 5 마이너스 P라고 하면 되겠네. 그래가지고. 네, 그 다음에. 너 확률을 안다고 해봐. P라고 해봐. 확률을 안다. 그 다음에. 기대값을 구한다. 그 다음에. 아니 상식적으로 생각해보자고. 그래서 기대값을 구했어. 그러면 여기가 P면 P 곱하기 1 마이너스 P 곱하기 G로 하면 뭐 기대값이 P가 나오겠네. P. 그러면 그게 옵션 가격인가? 그 다음에 어떻게 해야 돼요? 그 다음에 차리는. 그렇잖아. 우리 NPV 배웠잖아. NPV가 뭐야? NPV가 수년제 가치법이 뭐예요? 수년제 가치법. 여기 이름이 뭐라 그랬지? 학생? 임영 학생. 수년제 가치법 어떻게 계산하는 거야? 수년제 가치법. 할인해서. 바로 그거지. 알면서 왜 그래? 현재 가치법이 이 세상의 모든 자산 가치는, 모든 금융자산이고 실물자산, 그거의 가치는 무조건 NPV예요. 다른 말로 DCF 퍼센트이고, 미래에 이 자산이 가져오는 캐시플로우의 기대값을 구한 다음에 할인해주는 거예요. 그러니까 방금 말한 거에 의하면 기대값을 구해서, 이거의 기대값을 구해서 할인을 하면 가격이 될 것이다. 지극히 맞는 말입니다. 그렇죠? 지극히 맞는 말이에요. 그렇죠? 근데 이제 질문이 남는 거지. 과연 이 P를 어떻게 구할 건가? 한번 이렇게 한번 계산을 해보지. 이렇게 스탁 프라이스가 22달러면 너무 재미가 없다. 그렇죠? 좀 다이내믹한 프라이스를 한번 만들어 보기. 현재가 20달러고, 어차피 여러분 아는 것이 좀 다이내믹하게. 다이내믹하게. 지금 코스피가 얼마야? 빨리 확인해봐. 지금 코스피가 얼마지? 오늘 몇 시로 문을 닫았지? 스탁 네이버닷컴에 들어오면 되겠지. 오케이? 1935라고 하죠. 1935야. 이게 원피리어드 1년이라고 하죠. 1년. 3개월 후. 3개월 후에 외계인이 나타났어. 네, 외계인이 우리나라를 방문해가지고, 외계인이 우리나라 회사들한테 첨단 기술을 알려줘. 미국 넘는 세대 앞선 기술, 스타트랙 그 외계인들과 다리 큰 거. 그럼 우리나라 주가가 얼마 정도 될까? 엄청나게 폭등하겠지. 한 5천 정도로 폭등하지 않을까? 그러면 한 5천, 3개월 후에 외계인이 왔어. 외계인이 안 오면 어떻게 되나? 외계인이 안 오면 주가가 얼마 정도 될까? 1000 이상, 1900이라고 하죠. 계산하기 좋게. 그렇죠? 야, 이런 극단적인 케이스를 생각해보자. 그래서 우리가 이제 파생 상품을 하나 만드는 거예요. 어떤 파생 상품이면, 외계인이 오면, 일종의 내기지. 외계인이 오면 1달러를 줄게. 외계인이 오면 1달러를 주고, 안 오면 아무것도 안 줘. 이거랑 똑같이, 이거 PPT랑 똑같은 거네. 그렇지. 아니, 외계인 말이네. 그럴 때 우리 이제 가격을 하는 거야. 외계인이 오면 1달러를 주는데, 이 숫자는 우리가 일단 맞다고 가정해요. 외계인이 오면 1달러를 주는 게 파생상품 우리가 만든 거지. 외계인이 와서 5천이 되면 1달러를 주는 파생상품의 가격이 얼마일까요? 그냥 얼마면 되나, 얼마. 그럼 5천이 되면, 3개월 후에 5천이 되면 $1를 주는 파생 상품의 가치가 있어. 이걸 어떻게 구할 것인가? 외계인으로서. 솔직히 외계인이 오지 않는 한 3개월 후에 올 가능성은 없다고 봐야겠지. 그러니까 3개월 후에 5천이 되면 외계인이 외계인이 왔을 때 $1 주는 갬블이잖아. 갬블 내기잖아. 우리가 아까 본 콜옵션도 똑같아요. 주가가 $22 주면 $1 줄게랑 똑같았잖아. 콜옵션이랑. 이것도 마찬가지. 콜옵션인데 스트라이크 프라이스가 4,999인 그런 콜옵션이라고 볼 수 있겠지. 그럼 이거 어떻게 구할 건가? 그러면 아까 말한 대로 하면 되겠네. 외계인이 올 확률을 구해. 그렇지? 그럼 외계인이 오지 않을 확률을 구해. 그렇지? 그래서 이렇게 계산하면 되겠네. 그럼 얼마 정도 나올까? 얼마 정도? 외계인이 3개월 후에 와서 주가가 5천이 되면 $1를 주는 파생 상품이 있을 때 이거의 가격이 그런 파생 상품을 내가 팔고 싶어. 얼마에 살 거야? 얼마에? 아주 적은 가격 얼마 그럴까? 찍으면 되잖아. 0.15원. 오케이. 이거 상당히 호의적인 것 같은데. 진짜? 그러면 내가 10,000원, 내가 외계인 오면 10,000원 줄 테니까 나한테 100원 줄래? 그럼 준다는 건가? 그거 좋은 아이디어인데. 굿딜인데. 이 본인은 어떻게 얼마야? 예? 0.2원. 이건 더 좋아. 당장 가서 팔아야겠다. 그러면 내가 10,000원 줄 테니까 여기는 100원 주고 200원, 100원이 아니야. 0.1이니까 1,000원 주고 나한테 2,000원 주면 되겠네? 그런 거잖아. 굿딜인데. 또 다른 사람들 어떻게 그래서, 그래서 제가 계산하면 본인들이 계산을 외계인으로 확률을 계산해서 3개월 디스카운트 해주는 거 저 정도 된다라고 생각을 했나 보지. 과연 파생상품 프라이싱을 이렇게 할 것인가? 이게 문제가 있어. 여기서 이제 몇 가지 챌린지가 있어. 챌린지가 뭐냐면 과연 얘를 어떻게 구할 것인가? 외계인이 온 확률을 알아야 되잖아. 이걸 알면 우리가 확률을 구할 수 있게 값을 구할 수 있겠지. 외계인이 온 확률을 어떻게 구하면 되지? 외계인이 올 확률을 어떻게 구하? 어떻게 외계인이 올 확률을 어떻게 구하나? 잘 모르겠네. 나사에 가서 물어본다. 나사에 가서 물어보거나 한양대학교 항공우주공학과가 있나? 한양대? 없나? 서울대 항공우주공학과 교수님한테 가서 물어본다. 거기에 뭐 교수님 있겠지. 서울대 확실히 있으니까. 거기 항공우주공학과 교수님 외계인 물어보면 되겠네. 근데 파생 상품이 그냥 정답은 파생 상품가로 나사나 서울대 항공우주공학과 교수님한테 올 필요가 없다는 게 파생 상품 프라이싱의 아름다움이에요. 그렇다고 확률이 필요 없느냐? 확률이 필요해요. 근데 확률을 구하는데 외계인으로 확률을 구하는데 이 외계인이 구할 확률을 이 나사에 가서 굳이 물어보지 않고 외계인에 대해서 아무도 모르는 우리도 계산할 수 있다는 거지. 외계인이 찾아올 $1 준 확률의 파생 상품 가격을 외계에 대한 아무런 지식이 필요 없는 이것도 복잡한 것도 그냥 외계인에 대해서 아무것도 모르는 금융권에 있는 퀀트들이 계산을 충분히 하고 있다는 거. 거기까지도 갈 필요가 없어. 초등학생도 할 수가 있어. 과연 그게 어떻게 가능한 이야기냐. 외계인이 오면 $1를 주는 파생 상품이 있는데 그거의 가치를 왜 나사는 못해도 초등학생도 할 수 있는 그게 파생 상품 기본적인 아이디어가 뭐냐면 이 파생 상품 프라이싱을 하는 데 있어서 우리가 파생 상품 뭐라고 할까? 예를 들어서 피자의 가격을 알고 싶다. 그렇죠? 어떤 가게에서 피자를 팔아. 뭐 얼마에 팔겠지. 한양대학교가 피자를 파는데 우리 질문이 이거야. 그 피자의 진짜 가격이 얼마인가? 피자의 가격이 얼마인가? 우리가 그게 궁금하다고 생각해봐요. 우리가 만약 피자의 가격을 정확히 알고 싶으면 어떻게 하면 될까? 거기서 얼마라고 파는데 그게 정확한 가격이지 진짜 이게 페어한 가격인지 아닌지 알 수가 없을 거 아니야. 우리가 피자의 정확한 가치를 파악하고 싶다. 그러면 한 가지 방법이 뭐가 있을까? 네. 비슷한 피자집을 간다. 비슷한 피자집이 없으면 네, 바로 그거지. 한 가지 방법은 파생상품 별게 아니에요. 네. 직접 만들어 보는 거야 피자를. 네. 재료를 장만해서 도우를 장만하고 토핑을 장만해서 직접 만들어 봐서 그 피자의 가격이 얼마인지 우리가 재료비를 얼마인지 알면 피자의 가격을 알 수 있을 거 아니야. 답은 그거예요. 파생상품 가격을 어떻게 구하냐. 파생상품을 집에서 만들어 본다. 그겁니다. 집에서 만들어 보면 얼마에 들었는지 아니까. 그게 파생상품. 그걸 이제 멋있는 말로 하면 replicating portfolio라고 합니다. 딴 게 아니라 집에서 만들어 본다. 집에서 만들어. 어떻게 집에서 만들어 볼 것인가? 재료가 필요하네. 그렇죠? 외계인이 오면 1달러를 주는 파생상품이 있는데 이 재료가 있는데 이거 어떻게 만들 건가? 자, 재료는 딱 두 개만 돼요. 수학적으로 보면 시나리오가 두 개니까 스테이시 두 개라고 합니다. 스테이시 두 개니까 딱 상품 두 개만 있으면 돼요. 그렇지? 이 상품 하나는 있어. 주가. 따라서 움직이잖아. 다른 하나는 이거와 인디펜던트하게 움직이는 아무거나 있으면 돼요. 그러면 만들 수 있어요. 딱 두 개만. 서로 다른 방향으로 움직이는 동일하게 움직이지 않는 수학적으로 보면 리니얼리 디펜던트 하지 않는 정확히 동일하게 움직이지 않는 딱 하나만 더 있으면 돼요. 그럼 정확히 맞춰요. 이 교과서니까 쉽게 가장 그런 것 중에 심플한 리스크 프리 레이트는 누가 뭐라고 해든 정확히 그걸 주고 외계인이 오든 지구가 멸망하면 안 되겠구나. 외계인이 오든 말든 정확히 동일한 줄을 주니까 그런 게 있습니다. 그래서 리스크 프리 레이트는 여기서 보면 얼마라고 되어 있냐면 리스크 프리는 12%라고 되어 있네. 연 12%. 리스크 프리 레이트는 연 12%다. 12%니까 3개월 후에는 컨티뉴스 3개월 후에는 3개월이니까 4분의 1이니까 3%겠네. 어떤 일이 있어도 리스크 프리에서는 3개월 후에 외계인이 오든 안 오든 무조건 3% 준다는 거 아니야. 그러니까 이 주가랑은 따로따로 움직이고 그 두 개를 이용해서 만드는 거예요. 그래서 그냥 3%라고 합니다. 그러니까 2에 0.12 곱하기 3개월이니 3개월이니까 이건 2에 0.03이 되는 거지. 그러니까 이걸 그냥 편의상 R로 이렇게 쓰도록 합니다. R. 됐죠? 그러면 뭐냐면 오케이. 첫째, 주식시장에 일단 X를 투자해 보도록 하죠. X달러. 아니, 더 쉽게. 주식시장에 1달러를 투자하면 외국인이 오면 이게 얼마가 되나? 네? 주식시장에 1달러 투자했는데 외국인이 오면 얼마가 돼요? 이거 얼마가 되지? 아니, 정확히 얼마가 돼? 정확히. 3개월 후에 외국인이 오면. 5천이 되겠지. 네? 이걸 그냥 편의상 U로 해주죠. 외계인이 안 오면 (1935분의 1900이) 되겠네. 그렇죠? X달러를 투자하면 주식시장에 X달러를 투자하면 주식시장에 X달러를 투자했는데 외계인이 오면 X분해가 아니라 X 곱하기 U가 되겠지. X 곱하기 5천 나누기 안 오면 X 곱하기 D가 되겠네. 자, 다음에 Y달러를 채권시장에 은행에 투자하면 어떻게 돼? 3개월 후에 외계인이 오든 안 하든 Y 곱하기 R이 되겠네. 그렇지? 자, 그래서 에일리언, 그 다음에 넌 에일리언, 에일리언이 그래서 주식시장에 X를 투자하고 채권시장에 Y를 투자하니까 에일리언이 오면 말한 대로 X 곱하기 U가 되고 에일리언이 오지 않으면 X 곱하기 D가 되고 Y를 투자했으니까 오건 오지 않고 무조건 YR이 되겠네. 네? 그래서 결국 주식시장에 X달러를 투자하고 채권에 Y달러를 투자했으니까 에일리언이 오면 XU 더하기 YR이 되고 에일리언이 오지 않으면 XD 곱하기 YR이 되네. 그런 거지. 그래서 내가 어떤 포트폴리오를 만들어냐면 에일리언이 오면 이게 되고 에일리언이 오지 않으면 이게 되는 거고. 근데 우리 파생 상품을 보니까 에일리언이 오면 1원을 주고 에일리언이 오지 않으면 빵원을 준다 그랬잖아. 아, 그러면 이제 드디어 피자를 만들 수 있는 거지. 에일리언이 오면 1원, 에일리언이 오지 않으면 0원. 그렇지? 여기서 우리가 모르는 게 X, Y밖에 없잖아. 식이 2개, 미지수가 2개니까 풀 수 있겠네. 중학교 수학이네, 그렇죠? 요즘은 대치동에서 초등학생도 이런 거 푸는데. 아니, 푸는 것도 굉장히 쉬운 거냐. 얘와 얘가 같으니까 여기서 이걸 빼면 XU 빼기 XD는 1이니까 U, X로 나누면 U 빼기 0는 X는 1 오버 X는 되겠네? 정말 X와 Y를 구했어. X도 구하고 Y도 구해서 식이 2개, 미지수가 하나니까. 그럼 파생상품 가격은 뭐가 돼야 되겠지? X하고 Y를 알면? 백승유하고 뭐가 돼야 되나, 파생상품은? 자, 주식시장에 X만큼 투자하고 채권시장에 Y만큼 투자했더니 에일리언이 오면 이게 되고 에일리언이 안 오면 이게 돼. 근데 에일리언이 1달러를 준다고 했으니까 얘가 1이 되게 하고 이게 0이 되게 하면 정확히 내가 주식시장에 X를 투자한 것과 이거의 답을, 이거의 스타를, 대답을, 이거의 솔루션을 X스타, Y스타라고 하죠. 네. 이걸 풀면 X스타, 주식시장에 X스타 투자하고 주식시장에 Y스타를 투자하면 정확히 외계인이 오면 1달러가 되고 외계인이 안 오면 0달러가 되네. 그런 거잖아. 네. 그러니까 정확히 파생상품을 똑같이 우리가 만들어낸 거네. 그렇잖아. 주식시장에 X 투자하고 채권시장에 Y 투자하면 파생상품하고 똑같아야 되는 거잖아. 집에서 우리가 피자를 만든 거지. 그럼 피자 가격이 얼마가 돼야 되겠어? 피자 만드는데 토마토를 1,000원어치 사야 되고 피망을 10,000원어치 사야 돼. 그러니까 피자가 딱 돼. 그럼 피자 가격 얼마가 돼야 되겠나? 여러분의 피자 만드는 실력은 형편없어서 거기에 대한 가격 없다고 생각하면 얼마가 돼야 돼? 11,000원이 돼야 되겠지. 그러니까 여기서는 파생상품 가격이 뭐가 돼야 되겠어? 네? 뭐가 돼야 돼, 파생상품? 그렇지. 아니, 그렇잖아. 주식시장에 X만 집어넣고 채권시장에 Y만 집어넣으면 정확히 미래에 외계인이 올 때 1달러를 준다는데, 그래서 외계인이 오면 1달러 되는 거는 주식시장에 X만 집어넣고 채권시장에 Y만 되면 누구나 할 수 있는 거잖아. 그러니까 그 파생상품을 가지고 X 더하기 Y가 되겠네. 말 되지? 지극히 당연한 거예요, 그냥. 한번 풀어볼까? 외계인이 올 때 어떻게